Welcome to Iron Financial, the channel where we forge stronger portfolios by stress testing market narratives against cold, hard numbers. Today, we're putting AMC Entertainment on the rack. We are going to examine the entire financial framework of this company, from its very foundation, which is shareholder equity, all the way up to the massive, massive weight it's carrying on the roof, its $4 billion debt load. We're going to push on the load-bearing walls of revenue and cash flow and really see if they hold up under pressure. This isn't just a review. This is AMC's financial stress test. Let's get to work. Right, and to do that properly, we've identified 5 key points where this entire structure could potentially fail. Think of them as stress points. First, we're going to dig into the latest earnings report, which, honestly, seems to tell 2 completely different stories depending on how you read it. Then, we'll move to revenue and ask the tough question, is it built on solid ground? After that, we tackle the big one, that massive debt load that's just hanging over everything. And then we're going to dig into the very foundation of the stock, the dilution that has completely reshaped this company for its shareholders. Only after we've inspected every one of these points can we deliver a real verdict. Is this an opportunity or is it a trap? All right, let's start at the top, the Q4 earnings report. Now, on the surface, the headlines from this were frankly a total mess. You had some analysts calling it a solid beat, while others were pointing to some really significant weakness under the hood. This right here is where the bull and the bear cases really start to fork away from each other. The numbers are telling 2 very, very different stories. So the question we have to ask is this: are the positive numbers a genuine sign of a solid, recovering structure, or are they just a fresh coat of paint? Just some nice wallpaper hiding some fundamental decay underneath. Let's break it down. Okay, so first, just look at the left side of the slide with me. This is the bull case, loud and clear. Operationally, you have to give management credit. They tightened the bolts here. They successfully narrowed the company's losses. The adjusted earnings per share, or EPS, came in at a loss of 18 cents. Now, that was actually better than the 20-cent loss Wall Street was bracing for. Even revenue, you'll see, squeaked by with a small beat. Look, in a brutal environment, especially with the Hollywood strikes still casting a long shadow, this points to some really strong operational control. That is the sign of a competent team steering the ship through a storm.
A competent team, maybe. But they're steering a ship that's clearly taking on water. I mean, come on. Forget the adjusted EPS for just a second, and look at the fine print on the right side of that slide. Attendance fell 10% year over year. Let that sink in. 10%. That is the absolute core of the business. Getting people in the seats. It's the whole point. You can play games with accounting, you can beat some adjusted non-GAAP estimate that Wall Street pulls out of a hat, but you cannot hide a double-digit drop in your actual customer base. Total revenue is down, admissions revenue is down. This isn't just a tiny crack in the paint. This is a fundamental weakness in the foundation that you simply cannot paper over. Everything else is just noise.
You know, that point about declining attendance is the perfect place for us to apply some pressure. So let's stress test the revenue streams. The bull case here argues that they figured out a way to squeeze more revenue from fewer customers, which would be a sign of incredible pricing power. The bear case, on the other hand, says it's just an unsustainable house of cards. So let's see which one of those arguments holds up when we look at the numbers for the full fiscal year. Let's start with what is, in my opinion, the single most important number on the board. For the full year, consolidated attendance fell 2.1%. Okay, that might not sound like a huge number, but let's put it in real terms. They went from 224.2 million patrons in the previous fiscal year down to 219.4 million in this most recent one. That is nearly 5 million fewer customers walking through their doors and buying tickets. There is absolutely no way to spin this as a positive. This isn't a small leak that you can just plug. It's a noticeable crack in a core pillar of the entire business. You simply can't build a real, durable recovery on a shrinking customer base. It just doesn't work. But this right here, this is the pillar of strength that the bulls are building their entire case on. And it's a strong one. Yes, fewer people came through the door, I grant you that. But every single person who did walk through that door spent more money than ever before. Food and beverage spend per patron was up a massive 5.1% for the full year. It went from $7.25 to $7.62. Now, this is not an accident. This is pure pricing power. It is the direct result of a very specific strategy. Focus on premium formats, expand the menus, and leverage their loyalty programs. What they are doing is successfully extracting more value out of every single transaction. And that right there is exactly how you build stronger margins and a more resilient business model. And this table brilliantly illustrates the final result of that strategy. Just look at the numbers. Despite that 2.1% drop in attendance that we just talked about, every single revenue line is up for the full year. Admissions revenue grew 3.6%. Why? because higher average ticket prices from premium formats like IMAX and Dolby more than compensated for the lower foot traffic. Food and beverage, up almost 3%. And look at this other theater revenue line, up a staggering 16.2%. And what's the bottom line? Total revenues grew by 4.6% for the year. This is the entire bull case in a nutshell. The premium model is working. They are successfully offsetting lower traffic with higher spending per person. That is a viable, and I would argue, a potentially very profitable long-term strategy. Viable for now, maybe, but here's the billion-dollar question. Is it sustainable? There has to be a limit to how much you can charge for a popcorn and a soda before a family of four just says, you know what, let's just stay home and watch Netflix. But even more importantly, let's not forget the broader context here. The entire North American box office in 2025 was $8.9 billion. That sounds like a big number, but you have to remember that in 2019, before the world completely changed, it was $11.4 billion. So they are still operating in a severely damaged market that is billions and billions of dollars short of a full recovery. Relying on price hikes in that environment? Well, it feels less like a long-term strategy and more like you're just patching a leaky roof while the storm is still raging outside. At some point, you need more people, not just more expensive popcorn. Okay, so it's pretty clear the revenue picture is complicated. But now we have to move to the most critical part of this entire stress test. This is the single element that carries the most weight and frankly poses the single biggest risk to the entire structure: the debt. AMC is carrying a truly massive load on its balance sheet. So the crucial question we have to answer is whether this is a manageable, load-bearing wall that can actually support the business, or if it's just a house of cards ready to topple over at the very first sign of trouble. Let's be perfectly crystal clear about the number we're talking about here. As of the end of the last fiscal year, the aggregate principal amount of corporate borrowing stood at just over $4 billion. $4 billion. This is, without a doubt, the single heaviest weight on the entire company. Every single strategic decision they make, every dollar of potential profit they could earn, every single share they issue, it's all influenced by the need to service this mountain of debt. It is a constant crushing pressure on the financial structure that absolutely limits their flexibility and magnifies every single operational misstep they might make. And look, don't just take my word for it. This quote you're seeing, we pulled this directly from the risk factors section of AMC's own 10-K filing with the SEC. It says, our substantial level of indebtedness could negatively impact an investor's ability to recover their investments. The company is legally required to tell you, right there in black and white, that their debt load is so significant it could cause the entire structure to fail and completely wipe out shareholders. This is not a bear case theory, this is a disclosed corporate reality. But this is where you have to admit management has done some impressive work. What you're looking at here is the debt maturity schedule, and the bull argument is that this table actually represents some very savvy financial engineering. There was a huge debt bomb, as people were calling it, that was set to go off in 2026, and it genuinely threatened the company's survival. Through a series of really complex refinancing transactions, they successfully dismantled that bomb and pushed the bulk of their obligations way out into the future. Just look at that 2029 number. They've kicked the can down the road, buying themselves 3 crucial years of breathing room. That's time to let the box office recover and time to generate the cash flow needed to handle that future payment. They didn't dismantle a bomb, they just reset the timer on it. This doesn't solve the fundamental problem, it just postpones the day of reckoning. That $3.1 billion wall that's waiting for them in 2029 is immense. And in the meantime, let's not forget the interest on that debt, which runs into the hundreds of millions of dollars every single year, just continues to drain cash from the company every single quarter. That's cash that can't be used to innovate, can't be used to pay down principal, and certainly can't be used to return value to shareholders. It is a constant leak, weakening the financial structure day by day, and it doesn't matter if the due date is tomorrow or 3 years from now. So let's connect the dots. How did they push that debt wall back? Well, mostly by raising capital through the stock market. And that brings us to the very foundation this company is built on, its own stock. In order to survive, AMC sold shares, a lot of shares. And this raises a really brutal question for any investor holding this stock. Was the company's survival worth the permanent damage that was done to the value of the stock itself? It's time to examine the real cost of staying afloat. To really understand what happened here, you have to rewind and remember the context of 2020 and 2021. Theaters were shut down. Revenue was effectively zero. The company was on the absolute brink of bankruptcy. So management's #1 job was to ensure survival, period. Raising capital by selling stock wasn't just an option on the table, it was the only option. And as this timeline shows, they increased the share count massively to raise the cash they desperately needed just to keep the lights on. This was their lifeboat. It was a necessary move, and yes, it was a painful move, but it's the one that kept the company from going under. Without these moves, there is no AMC to talk about today.
A lifeboat, maybe, but it's one that left all the existing shareholders adrift in the ocean. For them, this wasn't survival. This was death by 1,000 cuts. Every single new share that gets issued makes your personal piece of the company smaller and smaller and smaller. It's just simple math. The company now has to generate astronomically more profit in the future just for your one single share to be worth what it was before all this. And here's the kicker. It's not over. Notice that at the end of last year, they doubled the number of authorized shares again, essentially giving themselves a green light to dilute shareholders even further down the road. The very foundation of this investment has been systematically and repeatedly watered down.
And once again, this isn't just my skeptical take on things. This is another direct quote from the company's own risk disclosures. They're explicitly warning investors that the stock is prone to, and I quote, extreme volatility, which could cause substantial losses. This is the direct consequence of all that dilution and the whole meme stock phenomenon that has completely detached the stock price from business fundamentals. When the builders themselves are posting a sign that warns you the ground is unstable and prone to sudden collapse, you should probably listen very, very carefully. Okay, we've pressure tested the earnings, we've pushed on the revenue pillars, we've measured the weight of the debt, and we've inspected the very foundation of the stock. Now it's time for the verdict. After all of this, is this structure an opportunity? Or is it a trap? From the bull perspective, the structure is holding firm. You have a management team that has proven they can navigate an incredibly difficult once-in-a-century environment. The record-breaking per-patron spending is not an anomaly, it is hard evidence of real pricing power and the success of their premium-focused strategy. They have skillfully managed their debt, buying them crucial time for a full box office recovery. And with their clear market leadership in premium formats like IMAX and Dolby, they are perfectly positioned to capture the upside from what is expected to be a massive blockbuster movie slate in 2026. The emergency repairs have been made, and the framework is now being properly reinforced for future growth. From the bear perspective, this structure is a trap, plain and simple. The operational improvements are just cosmetic repairs on a foundation that is fundamentally flawed by declining attendance. You cannot escape the simple fact that fewer people are going to the movies. That $4 billion debt load isn't a manageable weight. It's a crushing burden that siphons away any potential profit long before it can ever reach the pockets of shareholders. And the massive shareholder dilution has permanently capped any realistic long-term upside for the stock. The bottom line is they are still burning cash and are not sustainably profitable. It might look solid from a distance, but this structure is being weakened by insurmountable debt and an eroding foundation. So, that's our stress test. We've laid out the points of strength and the clear points of failure. The bull case sees a structure that has successfully weathered the storm and is now being reinforced for a much stronger future. The bear case sees a structure with a cracked foundation and a crippling weight that makes an eventual collapse seem almost inevitable. As always here on Iron Financial, we give you the analysis, we stress test the fundamentals so that you can make the final call for yourself. The only question left is the one right there on your screen. Is AMC's framework strong enough for your portfolio?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.